For decades, if you walked into any financial advisor's office, you'd hear the same old song and dance, the 60/40th portfolio. It was the golden rule, the bedrock of retirement planning. 60% in stocks for growth, 40% in bonds for safety. Simple, effective, and for a long time, it worked beautifully. But times have changed. The world has changed. And that trusty 60/40th playbook, it's not just outdated, it's broken. In this video, we're going to break down exactly why the 60/40th portfolio is dead and, more importantly, what the new, smarter replacement looks like as we head towards 2026. This isn't just about tweaking a few percentages. It is about a fundamental shift in how we need to think about building wealth in the modern economy. So, stick around, because what you're about to learn could completely change your financial future. Let's start with a quick history lesson. Why was the 60/40th so popular? The logic was elegant. Stocks and bonds were supposed to be like a seesaw. When stocks went up, you made money. When the economy got rocky and stocks went down, investors would flee to the safety of bonds, pushing bond prices up. So, your bonds would cushion the blow from your stocks. This negative correlation was the secret sauce. For about 40 years, this relationship held up remarkably well. It weathered recessions, market crashes, and periods of high growth. It was reliable. But the financial crisis of 2008 started to show some cracks, and the events of the last few years, especially the inflation shock of 2022, blew a giant hole in the theory. So what killed the 60/40ths? The main culprit is inflation and the resulting interest rate environment. The core problem is that the beautiful negative correlation between stocks and bonds has vanished. In 2022, we saw a nightmare scenario that the 60/40ths was never designed to handle. Both stocks and bonds got crushed at the same time. The S&P 500 fell, and long-term treasury bonds also fell significantly. The seesaw broke and both sides crashed to the ground. Why? Because the Federal Reserve had to aggressively raise interest rates to fight off the highest inflation we've seen in 40 years. Here's the simple rule you need to remember. When interest rates go up, the price of existing bonds goes down. Think about it. If you own a bond paying a 2% coupon and new bonds are being issued at 5%, nobody wants your old low-yielding bond unless you sell it at a steep discount. So, as the Fed hiked rates, the value of that safe 40% of the portfolio plummeted. At the same time, higher interest rates make it more expensive for companies to borrow money, which can slow down the economy and hurt corporate profits, causing stock prices to fall. So, rising rates became a double whammy, hitting both sides of the portfolio simultaneously. The so-called safe haven wasn't safe at all. It was a trap. The second major issue is simply lower expected returns. For decades, we've been in a period of declining interest rates. That was a massive tailwind for bond prices. But now, with rates off their historic lows, that tailwind is gone. We can't expect the same kind of price appreciation from bonds that we saw in the past. Your returns will mostly come from the yield, which, while better than before, is still fighting against inflation. On the stock side, valuations are still historically high in many sectors. That means future growth might not be as spectacular as it has been. So, if you're re-expecting your 60/40th portfolio to deliver the 8 to 10% average annual returns it did in the past, you might be in for a rude awakening. The math just doesn't add up anymore in this new environment. So, if the 60/40th is dead, what do we do? Do we just put all our money in a savings account and hope for the best? Absolutely not. We evolve. The replacement for the 60/40th isn't another rigid, one-size-fits-all formula. It's a more dynamic, diversified, and modern approach. Let us call it the modern diversified portfolio for 2026. This portfolio is built on 3 key pillars. Pillar 1, redefining the growth portion. Instead of just stocks, we need to think more granularly. Yes, a core holding in a broad market index like the S&P 500 or a total world stock index is still essential. This is your foundation, but we need to be more strategic. This includes adding specific allocations to international and emerging markets. The US has dominated for the last decade, but these cycles don't last forever. Other regions may offer better valuations and growth opportunities in the years ahead. We also need to consider specific growth themes, like technology, artificial intelligence, and clean energy. A small, tactical allocation to these high-growth sectors can significantly boost your returns, even if they come with more volatility. Think of it as adding turbocharged engines to your reliable family car. Pillar 2. Rebuilding the defense portion. The 40% in traditional bonds is the broken part. We need a better defensive strategy. So, what replaces it? A multi-asset income and stability sleeve. First, short-term bonds and treasury bills. With higher interest rates, you can now get a decent low-risk yield from these, without the long-term interest rate risk that crushed bond funds in 2022. They provide true stability. Second, we add a slice of high-quality corporate bonds and even some high-yield bonds for an income boost. But we have to be selective. Third, and this is crucial, we bring in real assets. I'm talking about things like real estate investment trusts, or REITs, and infrastructure funds. These assets tend to have cash flows that are linked to inflation, providing a natural hedge. When prices go up, rents go up, toll road fees go up. This is something traditional bonds just can't offer. And now for Pillar 3, the game changer. Alternatives. This is what truly separates the old 60/40ths from the modern portfolio. For years, alternatives were only available to the ultra-wealthy and institutional investors. But today, thanks to new ETFs and funds, everyday investors can get access. What am I talking about? I'm talking about a small, strategic allocation, maybe 5 to 15% of your portfolio to asset classes that have low or no correlation to stocks and bonds. This is where we find our new CISO. So what's in this alternatives bucket? First, commodities. A broad-based commodity fund, which might include energy, industrial metals, and agriculture, can do very well during inflationary periods, exactly when stocks and bonds struggle. Gold is another classic alternative. It's often seen as a safe haven during times of economic uncertainty or currency devaluation. Second, we can consider strategies like managed futures. These funds use complex strategies to profit from trends in the market, whether it's going up or down. They can provide a source of returns that is completely independent of the stock market's direction. By adding this alternative sleeve, you're building a truly resilient portfolio that doesn't just rely on one relationship. Stocks versus bonds do work. You're creating multiple sources of defense and potential growth. Let's put it all together and visualize what this 2026 replacement portfolio might look like. Instead of a simple 60/40th split, we might have something like this. 50% in the growth bucket. This will be 30% in a global stock index fund, 10% in emerging markets, and 10% in thematic growth ETFs like AI or robotics. Then you'd have 35% in the income and stability bucket. This could be 15% in short-term bonds, 10% in global infrastructure funds, and 10% in REITs. Finally, you have your 15% in the alternatives bucket, maybe split between a broad commodity fund and a gold ETF. Do you see the difference? It's not just two asset classes anymore. It's a sophisticated blend of at least 7 or 8 different, non-correlated assets. The exact percentages will, of course, depend on your personal risk tolerance, your age, and your financial goals. A younger person might have a larger growth allocation, while someone nearing retirement might beef up the income and stability sleeve. The key is the structure. This framework is designed to be more resilient to inflation, rising interest rates, and the kind of market shocks that crippled the 60/40ths. It's about building an all-weather portfolio, not one that only works when the sun is shining and interest rates are falling. The world of investing has evolved, and our strategies must evolve with it. Sticking to the outdated 60/40ths model in today's environment is like trying to navigate a new city with a map from 1980. You might eventually get somewhere, but you're likely to get lost, frustrated, and you'll definitely miss all the new, better roads. By embracing a modern, diversified portfolio that includes real assets and alternatives, you're giving yourself a much better chance of navigating the complex markets of 2026 and beyond, and successfully reaching your financial destination. Thank you so much for watching. If you found this breakdown helpful, please hit that like button and subscribe for more content to help you invest smarter. Let me know in the comments what your portfolio looks like and if you're making any changes. See you in the next video.